It is time to bring on Matthew Timpane from Schaeffer's Investment Research. Matthew, how's it going today?
Not too bad. How about yourself, Aaron?
Pretty good. It's funny. I remember last time I introduced you here, I had to ask about your name, and I remember you told me the funny story about the funniest way someone's mispronounced your name. But I find myself wanting to ask again. I don't think I remembered exactly if I said it right, Timpane or Timpani.
Yeah, you said it perfect. Hopefully nobody gets offended, but it was a funny story. It was in college during a women's studies course for psychology of women, and the teacher was a male teacher, and I was one of two guys in the class, and he called me Matthew Tampon right in front of everybody. So as you can imagine, I don't really embarrass easily, but that one hit kind of hard. So.
Yeah, and I remembered the anecdote, obviously, of someone mispronouncing your last name, Tampon, but I forgot the detail about it being a teacher of a women's studies class. So that's a good wrinkle in the story that makes it just that much funnier. But Matthew, you want to go ahead and tell us exactly what we'll be talking about today?
Yeah, so we'll do just a real quick kind of market update, kind of give our viewpoints, and then we're going to go into two strategies to keep you afloat in volatile times today.
Beautiful. All right, Matthew, well, I'm going to give you the floor. I will be hanging around backstage, so if you need anything, feel free to hit that private chat, but I'll let you take it away.
All right, wonderful. All right, thank you, everybody, for joining me. Like you said, Matthew Timpane. I'm a senior market strategist over at Schaeffer's Investment Research. We've been in business now for about 41 years. We're actually just going to celebrate our anniversary. We're based out of Cincinnati, Ohio, and I'm a chartered market technician as well. So today, we're just going to go right into it because I got a lot of things to kind of go through. So just a real quick kind of market update. We have some short-term positives obviously happening here. We've seen, kind of a bounce off the lows. But, long-term structurally, we're still kind of in a bearish pattern. So you can't get too ahead of yourselves in these types of markets. It's really kind of a tough spot that we're in, and you want to be able to stay nimble and agile. And the two strategies that I'll share later are reasons why we're kind of using these strategies a lot in this type of market. So we are kind of, late cycle here. Securities that are performing well are, healthcare, staples, utilities. We're even seeing a little bit of a bounce in long-term treasuries. Not sure if that will hold, but, those are all kind of late cycle signals that, we're in the late part of the cycle. And we really could be kind of looking for that final down leg if it's going to happen. For years, macro really didn't matter. A lot of people, kind of said, hey, it's dead. Well, right now, macro really matters. So when you're in a prolonged bull market, fueled by easy money environment, through monetary and fiscal stimulus, it doesn't really matter as much, those macro indicators. But right now it does. And the Fed has clearly indicated that they do not have the markets back. And if you don't fight the Fed on the way up, why would you fight the Fed on the way down? So some things that I've posted recently in recent articles was talking about seasonality, and talked about it at the last boot camp as well. July, is one of the most seasonally bullish, if not the most seasonally bullish month. But the trajectory that we were on, there was only 3 years worse: 1932, 1940, 1970 in the first half of this year. So I wanted to pull up an analog here that I used in one of my recent articles. It kind of shows you what can kind of happen. It typically finds a bounce if you look in July, mid-July. Kind of finds a little bit of a bullish move, even in the worst of markets. That can kind of last when you look at history into August, maybe even September, October. Some of these cycles have had a little bit of a prolonged little bear market rally. But typically we head back down in market conditions like this. So it's a reason why we're still cautious on the market. August is a pretty much flat month for seasonality, but it has a pretty wide standard deviation of 4.55. So it's just something to kind of keep in the back of your head as you're trading these markets, to know where you are in the big picture and the short-term picture, because you need to be able to navigate both sides of the market to stay afloat. So another thing, just kind of quick look at the S&P 500. Like I said, it's seen many little positives here, putting in some, some higher lows. It did move back above the 61.8% Fibonacci retracement level, which also was right near the Biden inauguration level. So right now, Joe Biden's presidency is in positive territory. But we also moved back above the 40-day moving average, which is something that we watched pretty closely over at Schaeffer's. As you can see, it really kind of capped those gains in June. And then additionally, the market has now moved back above the minus 20% year-to-date level. So we're kind of out of this bear market for now from technical standpoint. Don't really love that term, having to have a hard line of minus 20%, but that's what the technical wording, I guess, is for it, right? So all of this really needs to kind of hold here if we're to expect a continued move to around 4,000, where that will be the big test. We'll be testing that downtrend, year-to-date downtrend that we've been in. Also, if you look at S&P 500 by using like the SPY, the ETF open interest levels, that's where the largest call strike is right now. It's not that big in terms of open interest, not anywhere near the put strikes, but it's something to look at and say, hey, there could be some possible resistance in that area. Last time we kind of talked about some major monthly moving averages. I don't have them on my charts here, but they did catch the lows. So the 36-month is around 373 when you use the SPY, so about 3,730 on the S&P 500, and then the 40-month is around 364, 365 area. And as you can see, that 40-month held, and then after that, the 36-month held. So those are the signs where, hey, we might have a little bit of a rally underway here. Obviously, those are major long-term moving averages. If you move below those, that's where you're going to want to watch out for a big flush out. So with that said, let's look at the VIX quickly. The VIX is kind of telling us, hey, we're still in a cautious standpoint. We moved below the 30 level, and then we moved it below the 25 level, which has marked many kind of peaks in the VIX in dip buying opportunities in the past bull market cycle. So you figure it'd be an area that would, try to hold. I was kind of looking at the 24 level because that's the level that kind of triggered us back in March to actually get a really good rally during this bear market. So that's what I'm kind of looking for to put more risk on if I think we can have that possibility of breaking out of that downtrend, maybe for like a really big bear market rally or possibly a new bull market being born. We just don't know. But that would be my level in kind of gauge is a VIX below 24. Another thing that's kind of helped with this rally is large speculators net position now are the most bearish since June 2020. And they've been really historically wrong when you look at the chart. Back in 2011, they basically kind of marked that low there. They marked the double lows basically being net short in the 15 through kind of 16 correction, which was also kind of Fed induced. They also marked the low, actually even went even lower after the COVID pandemic. That was June 2020. So they're the most net short since then. It's likely a reason why when you see these larger fund speculators getting extremely negative, it gives you kind of a little boost for a rally because they have a lot of hedging exposure. A couple of things that we look at are put call ratios, if you've seen before, and we do it from a component standpoint of the indexes. So it's equities within those indexes that we're usually using these put call ratios from, and we aggregate them as a whole. They're still very elevated, and they've come down. They can stay elevated in bear markets, though. So we'd really like to see them kind of crack those previous lows to get a real good rally underneath way. Until then, we still kind of remain somewhat cautious. But from other sentiment standpoints, we had some real good indications that we were going to get this rally. Looking at the National Association of Active Investment Managers, which I believe the recent reading was 26.74, we're looking for tradable bottoms. And how do we define that? We look at a 2-week percent change. So this was telling us that a rally might happen the other week when we saw that go below that level for us. Another thing is investors' intelligence reports that we use, and we quantify this data as well. We reached lows recently that we haven't seen in the bull-bear spread since really the great financial crisis. Today's data actually bumped us up a little bit, so I don't have the new charts, but it brought us up to the zero bounds on this and moved us now into the 20th percentile. So if you can see here, that we were in the 10th to 20th percentile earlier last week, and now we're in the 20th to 30th percentile. Returns are pretty good when you look, 1 week, 2 week, 4 week, 8 weeks out. you just got to realize we're in a bear market, so that doesn't necessarily mean it's going to happen, but some data is on your side. From a structural standpoint, like I said, we're still very much in a bearish market. These are just the yield curves, various yield curves. We've got the 10-2s here, the 10-year 3-month, the 30-year 10-year, the 30-year 5-year. The 35 has flipped negative twice. The 10-2s has flipped negative twice. So the outlook is pretty gloom. What I would be watching and what everybody was kind of saying was, reason why they're not as worried about the recession prior was that 10-year 3-month was still kind of rallying, and that's really kind of your last straw. When that thing goes negative, that's when you usually you can see that recession price, and you can see the markets really react to that, and it's been falling rapidly over the past month. So that could be signaling something to the Fed that, hey, I understand, you're doing these rate hikes, inflation is rampant, you're trying to get that underneath control. But maybe, it's an early indication that, hey, maybe inflation, data is going to start being, more positive for the markets and pull in a bit as they've raised rates. So that's to be seen. I'm no interest rate, expert, but is what I'd be watching. If that goes negative, then, markets definitely could see more pain in that. The dollar index is still kind of rallying here. It's now pulled back to this kind of big kind of support range area. That's just something to kind of watch as well. If it kind of breaks through, maybe we can get an actual ultimate low. If it holds these levels, you're going to want to kind of still be very cautious going forward. So let's get on to what we're here for. The two strategies that kind of keep you afloat in the volatile times. The first one, is pairs trading. We talked about a bunch of different strategies last time. This time I'm just going to really highlight and kind of go deeper into this to help you understand how to use them. This is an easy to understand system when you're doing pairs trading for beginners that are looking for ways to really navigate these markets. A lot of you've probably been whipsawed by the market, so it hasn't been easy. You're not selling any options in the strategy, so you don't have to worry about margin requirements. I also acknowledge when you're first starting out trading options, it's a bit weird kind of selling puts or calls when you first start. It's not something you're used to. Because it's just different than in the world of equities, right, where you can only be long or short. So you might not be that comfortable with it. So this is just like buying and selling stock, though, with the exceptions, it's used with options. So you're just simply buying calls for one leg and buying puts for the other leg. It's a conservative strategy compared to buying outright calls and puts in directional bets right now. And you're essentially market neutral. You don't really care what direction the market goes as long as it moves. So you should expect smaller gains, though, since you are putting on one long kind of option here and then one short kind of idea here. So you'll be able to have smaller losses, though. So that's also an added benefit. So we usually target gains of 100% in directional bets or 200%. Well, in pairs trading, you're going to be targeting about 50%. And your losses, you're going to want to make sure that you keep those to minus 25%. This really can be traded in bull and bear market environments and even range-bound markets, as long as that range isn't extremely tight. In essence, what we're trying to do here is take advantage of correlated stocks that have diverged in price. Correlation is the relationship between two or more variables with a range of -1 to +1 that is generally measured on a historical basis over a month or more. Strong positive correlation is defined by 0.5 to 1.0. Moderate is 0.3 to 0.5, and weak positive correlation is between 0.1 and 0.3. Vice versa for negative correlation, if you want to look at it from that kind of standpoint. There is no correlation that's really defined between 0.1 and negative 0.1. So positive correlation, like I said, what this means is stocks just generally move in the same direction, and negative correlation means they just move generally in the opposite direction. We're reducing the risk of the trade by essentially trading the spread between these two securities now. So if one asset that has been strongly correlated to another is making new highs and the other is making maybe new lows, you're making a bet whether that divergence will persist or that it will close the gap and come back into high correlation. Just depends where you're going to put this trade on. So when we're talking about the spread, got to go back here. So when we're talking about the spread, we're talking about ratio charts. We're not talking about relative strength index. So when we talk about relative strength, it's in a ratio chart, not an indicator. Many of you have likely seen someone post ratio charts, maybe myself. It's often done pitting one sector versus, say, the S&P 500. All we're really doing now instead of that is we're going one stock versus another stock. You can do this on platforms like TradingView, stock charts, many others. They allow you to do this for free out there. So how do you find pairs trades? Well, there's two ways to find correlation. You can use a matrix that will hold securities with a sector or industry in them, and you can kind of look at that matrix. I'll show an example of that in a little bit here, but I don't think there is any really free software providers out there for a matrix. I could be wrong, so if I am, please add that in the comments for others to be able to go view. But with TradingView or stock charts or any other basic, kind of trading platform that's out there that you can even use for free, you can make it as an indicator as well. You can just put in the lower side and then you'll be able to use it. So as you know, one of the things is when you're looking at kind of a pairs trade, I think about it as a rising tide lifts all boats, right? So typically you will be searching for pairs within a sector or industry as the correlation will be higher since sectors and industries have this tendency to move together as a whole. And one of the things that you want to do when you're kind of looking through those securities within that sector or industry is really kind of look for names that rhyme. And what do I really kind of mean by that? Well, we have found that betting on pair trades with names that rhyme rather than that are exact can produce some of the best returns. So for example, you could just use an Apple Meta or NVIDIA Salesforce, right? So NVIDIA Salesforce is, you got semiconductors versus business software essentially. And Apple Meta, you'd have hardware versus, social media software. So, correlation will likely be a little bit lower, but you will be taking on a little bit more risk to have a greater chance of both those legs finishing profitable. Names that are similar, which is definitely something we still do, but they're going to act a lot more like a straddle where you're buying a put and call option in the same security. And you're really just looking for the volatility movement there. So they have a tendency to act like that more often than not. So in the case, you're going to need that big move. There is less risk involved in that, though, because they'll typically go in that same direction then. And the higher the correlation, the less risk you're actually taking on pairs trades. So just to show you an example here, you have correlation matrix. This is a basic one for me with sectors. I got Bitcoin in there and the S&P 500 just so I can kind of see what the different correlations are within the market. And then, so typically, what are you really kind of looking for when you're looking for these pairs, right? One of the biggest things when trading pairs is making sure that you're buying cheap options. So historically, you want to find low IVs. Most brokers have what they call IV rank or IV percentile. Something of that nature can tell you what part of the range IVs are in from the last 52 weeks. The lower the percentile, the better. I know, major brokers out there, Thinkorswim, Tastyworks, whatever, you name it, TradeStation, Interactive Brokers, they all have this feature, and so do the others as far as I'm aware of. So you'll be able to pull this up. A lot of them can pull it up as an indicator or in a watch list, and you don't have to go too far, really kind of out in the future. We typically look at this as at the money, 2 to 3 months out in expiration, so 60 to 90 days. But you can adjust this a little bit to your viewpoint maybe on the trade. I wouldn't suggest buying too much more than 60 deltas though, because we're really trying to capture convexity here when you're trading options. And so you don't want to kill all of that and basically make it into a stock trade just itself. Another thing is you're still going to want to make sure you have an edge in your trade for both trades. Don't just go out there and, throw out a bunch of pairs trades because it's a neutral strategy thinking that it's going to work out, and when you hit your targets, you're just going to take profits. You want to be able to look at each leg as, I would take this as a directional bet on the long side. I would take this as a directional bet on the short side outright. So, make sure you have drivers, whether they're moving averages, support resistance zones that you're trading against, anchored VWAP level, minus 10% kind of like year-to-date levels or year-over-year levels, market cap levels, whatever you're using to kind of gauge that kind of trade. Make sure you have an edge in the trade, and preferably something that somebody obviously doesn't know about or not a lot of people know about. So maybe something's trading at a peak put level, and you want to take that long, and you found another pair that's trading at a peak call level, and that you think that's going to be resistant. So make sure you have those. And then finally, adjust for notional value. It's rare to find options of separate stocks whose option contracts match notional values, just because of asset price and volatility. So you want to make sure to adjust to get as close as possible to equal dollar amounts outlaid for each contract. So say the call option contract totals $2,000 and the put totals $1,000. What you're going to want to do then in that case is you're going to want to have one call contract for $2,000 and two put contracts for at $1,000 a piece to equal $2,000. That way you have that pair trade both at $2,000 on each leg. You're not going to get this exact most of the time, so just make sure it's as close as possible. That way the pair trade is working for you in the right way. So just a couple quick examples of this. A recent trade that we did, this was a Caterpillar deer pair trade. It was entered on 5/26, so May 26 over here. And we entered this trade as it broke out of this wedge. It was also breaking above year-to-date break even. So right about here. And, it had, definitely room to run on analyst recommendations. We thought there could be some upgrades if we really weren't heading into a recession. Another factor was our 50-day put call volume ratio that we used with buy to open data was in the 97th percentile. So a lot of speculative traders were bearish on the stock, and it found support near its peak put. So we were targeting a move to 240, which was the previous top. And, you can see we almost got there. We got the 230, and that's where it failed and faded. We could have taken some profits off at that point. We didn't in this case, but I'll show you and highlight how this trade ended up being a winner anyways. Down here, I did put down here, since this is a trading view chart, you could use, this is a relative ratio chart right here down as an indicator, and then this is the correlation. So you can see the correlation breakdown that we're kind of gauging off of on this trade for the cat deer trade. Here's the deer side of the trade. So it was approaching 350 at the time that we put the trade on. I knew there was some areas that it could kind of run up against that 360 area, but we wanted to get this pair trade on, at the right time. And it was still kind of holding below year to date at that point. Our open interest ratio that we use was showing that there was a bunch of call activity in this stock that was just kind of built up. So, and there was decent open interest at that 350 strike that, just above it, that could prove to be resistance. So it did run up, it tapped 360. That's where it failed back and dropped down to our target, which was $300 on this. That way that option would return at least 200%, which, that $300 target was based off of the pandemic lows anchored VWAP. So we had to close out June 1st around plus 50% on this pair trade. We did leave the cat call open just in case as a lotto. That was worth only about 20 cents at the time. It did expire worthless in our July contracts, but you never know. If you could have got a big rally, you could have maybe got profit on both sides of the legs, or at least less of a decline on that call side. And then this is the relative ratio chart for the cat deer, kind of zoomed in. And this is what we were looking at. We saw that cat kind of broke out, was outperforming deer. And we didn't really care what way it went, as long as cat continued to outperform deer. That's what you're really looking for, and that's what I'm talking about when you're trading against the spread. Another quick one is CCL and NCLH. We entered this around 428. We took profits on June 16th, around 50%. And then we finally closed it out July 10th, where we were stopped out because it kind of broke across a short-term downtrend, and there really wasn't any convexity left in the trade. As you can see, when that broke out, we stopped out and went the rest of the way. The final strategy here, since I only got a few minutes left, is vertical spreads. If you want to stick to some directional bets, slightly out of the money, vertical spreads can really help in this market. It's a simple strategy of buying one contract that is closer to at the money and then selling another contract further out of the money. We're not talking about buying far out of the money. We're talking about, 40 deltas, maybe 35 deltas here. This is kind of how it looks. As you can see, your upside will be capped by that call that we sold above. But, so you're limiting the convexity of the option. But in a bear market action, there's plenty of positives that outweigh that negative. So you can place trades with less upfront capital, allowing smaller accounts to trade larger price securities that they otherwise might be priced out of, since you are selling that contracts against a long premium position. You also have a higher probability of profit from this trade structure, since your break even is lower from selling that higher out of the money contract. So you need less of a move in your direction than you would for an outright long premium position. And then time decay is also muted compared to owning a long premium position, since theta decay is slightly offset from the contract that you sold, since theta decay in that contract is actually working for you in your favor. So additionally, stop losses are a little bit easier to manage, since a big move that goes against you works in your favor for that contract that you sold, because in this case, a lot of times, instead of like maybe say a 40% loss on a long premium only contract, you might only be down minus 25% on that spread. So here's an example of that for you. This was a trade we recently just did. We did this on Friday, actually. Mara Digital Holdings. We were targeting this move off of a gap up level from December 2020. So we kind of viewed this as, hey, it's possible support now. It was consolidating in a mini bull flag after a large positive volume day on July 8th there. And then our in-house volatility scorecard was an 81. Our buy to open 50-day put call ratio was in the 95th percentile. It was near peak put and peak call, which resided just at the 10 strike. So what we did was we bought the 10 strike and we sold the 12.5 strike for August. So we knew, this thing really could surge if we broke above that level, and you could see a big squeeze. On top of that, short interest is just massive in this. It's around 31%. And then when we enter the trade, what we do is we make sure that we kind of calculate for our subscribers, the average of what people are getting entries in. Our average was about 35 cents. Yesterday, we did take profits on the first half around 200%. And today, I don't know if it's still up there, but it exceeded that sold call strike level. Sometimes you just leave it open because you'll have some variation before you get to expiration. But I don't know if we've taken the rest off right now, but as of right now, it's sitting as the second half of that trade sitting as a really big winner on our books. So that's just another thing. And we just kind of recently started this program, so I wanted to highlight this vertical spread trader that we're now have open for subscribers. So that's it for me today. As always, thank you for your time. We'd love to speak with you about your options trading. Give us a follow on Twitter. Come over to Schaeffer's Research. We have a bunch of free educational content for you to learn about options trading, as well as unique market news just relating strictly to options.
Beautiful. Well, thank you, Matthew, for coming on the Benzinga boot camp today. Like you said, you've got those Twitter handles up there for folks to find more, or straight from Schaeffer's website, but at Schaeffer's on Twitter or at Timpane. Matthew, thank you again for coming on Benzinga's boot camp, and I hope you have a great rest of your Wednesday.
Always a pleasure. You too.